Hi, everybody. Thanks for joining us today for our first full day online event, the Housing Innovation Staycation. This is the second session where we'll be focusing on single-family rentals. I'm Betsy Scott. Paige on our team is going to be co-hosting this session with me. Single-family rentals has been a topic of interest for us in the Alliance for a number of years. Actually, one of the people you're going to hear from today, Matt Blank, was one of our first presenters in Chicago in 2016. Back then, our chairman, George Casey, was envisioning that would become a great way for homebuilders and developers to diversify their product portfolios, increase housing production, and deliver more options and greater attainability to consumers. While single-family rental is still a smaller part of annual housing production, it's a growing sector with opportunities for new relationships, expanded production, and greater accessibility and attainability for consumers. So George saw that a few years ago, and it has come to fruition now. And today we have two experts who are going to kick off the discussion and share their opinions. First, you're going to hear from Dylan Rhea with RealFoundations. He was formerly with Ernst & Young. He has more than 20 years of experience in real estate. And currently he works with clients to transform their businesses, develop operating models, long-term technology strategies, and enterprise platforms. He also has certainly experience and expertise with leading builders to get into single-family rentals and build to rent. So he's going to share that with us. And then after we hear from Dylan, we'll hear from Matt Blank with BB Residential. He started acquiring homes to rent in Phoenix. Then he transitioned to build to rent single family home communities in 2012. He is a whiz with numbers and knows a lot of good information about the financial background of being a deliverer of single-family rentals in this space. And he recently formed a partnership with Toll Brothers to expand on a national level. So he's got some good insights on that front as well. So I'm going to turn the floor over to Dylan.
Thank you, Betsy. Thanks, everybody. I really appreciate the opportunity to speak today. And you know, we do feel that single-family rental and really all parts of it, this really is significant. It's a significant change in terms of the real estate industry. So we're definitely interested to talk about it today. So we'll flip on to the next just quickly. I appreciate the introduction. Just a quick 15 seconds about who we are. So again, we are entering our 20th year as a company. So we're a management consulting firm focused solely on real estate. So home building is the group that I run out of Orange County, California. But we work with developers, owner operators, service providers, institutional investors, corporate occupiers, basically anything to do with real estate. So I think, you know, over the last decade or so, we've focused heavily with home builders around business process improvement. As Betsy said, systems implementation it's a big part of that, but we've also had the pleasure of working with a number of large home builders in mergers and acquisitions, which is obviously a pretty hot topic recently. So we'll go to the next one. So again, for today, I think our goal is to really talk through, as far as single family rentals go, trends and drivers. A lot of these things, you know, have really been front and center in the industry for, as Betsy said, for a long time. This is not a new subject, but we're going to kind of talk about what we're seeing with our clients in terms of what they're focused on and how the industry is changing. And again, from our perspective, I think it's a little bit different because we started out working with a lot of companies that were looking at single family rental around the existing product portfolio. So buying up existing product and basically, you know, bringing those into portfolios and managing those things across the country. We had the pleasure of doing a lot of work with Invitation Homes in their work with Starwood Waypoint, really to build the operating platform to make that actually happen. And as a part of that evolution, what we're seeing now with our national home builder clients is really the evolution of that, where our national home builder partners are actually, you know, looking to either build or partner with builders or partner with operating operating partners to actually get more into that product. So we've seen it kind of go from beginning point to what it is now, and it's changed quite a bit. And then what we'll talk about is, there's a lot of focus on rental metrics. So again, this really is a new industry. It's not traditional home building. So we'll talk a little bit about what we're seeing in terms of how those metrics are actually applied, and how we're seeing those things in home building. And then what's the outlook? A lot of these things, again, there's a lot of this content that's out there, a lot of discussions that are happening. But we'll talk about what we're seeing and what our clients are actually seeing as it relates to what happens next. So we'll go to the next slide, please. Okay, so just broad trends. So how is this actually happening in the single family sector? How is it expanding? So as we all know, there's extended periods of declining home ownership since 2008. I think the numbers are that in 2016 there was a post-recession low, about 62%. So there's issues with housing affordability, mortgage interest rate challenges that really continue to hinder buyers. So again, home ownership across the board has continued to decline. So, there's ongoing challenges in meeting those requirements for traditional home purchase. So that does include saving for a down payment, but also includes finding affordable product. So really what we're seeing is not only those economic components, but also there's a trend where the number of households that are actually, looking for housing, apartment living doesn't really address what they want or need, but buying a home actually it's not practical either. So, there's a lot of other key factors that we're seeing as well. Affordability, we talked about, flexibility in lifestyles, really shifting priority in terms of housing. What's the priority in actually buying a house instead of spending that money elsewhere? Choice and availability of options, other than buying a home or going and renting an apartment. So this new kind of product type has emerged in terms of a new choice that actually is very compelling in terms of, what a lot of families are looking for. So, I think in addition to that, what we're really seeing is what we're calling, this is kind of an awkward term, but it's really kind of the multi-familyization of single family rental, the product in general. And it's really kind of moving away from just a single rental home in a neighborhood to something that's more of a community or a lifestyle. So we'll talk a little bit more about that in a second. So, I think as a result of all these factors and others, the housing sector is really continuing to expand to include what we're calling traditional single family rental and then single family rental build to rent, right? So two different things. So, just to talk a little bit more about that point, the single family rental housing sector, again, the majority of that product came from existing older homes that were transitioned from privately owned or rented. There's been a gain of about 5 million existing homes that have been reclassed from an owner to a rental status, with about 13 million total. So again, these are big numbers that we're talking about. But I think in general, we're saying that, 98%, give or take, of that inventory is really owned by individuals and small investors. And even though all this institutional money has come in, to buy these portfolios of homes, it's still overall, the numbers are small. It's a couple percent total. So, I think if you look at how this is all driving forward, the home builders now are shifting a portion of their production to this market for a lot of reasons that we'll talk about. And the partnerships that are being built to actually build these homes and manage these homes in the longer term, there's some very interesting things that are happening that are new, right? So just a quick kind of snapshot of what we've seen in terms of what's driving all this. So just in the context of single family rental, again, this is just a quick picture. We're talking about 137 million total housing units, 122 million occupied, 46 million that are rented. Again, 13 million plus detached one unit rentals that are out there. So this is not a small number, right? It's a significant portion of what's out there in terms of the rental market in the US. Okay, so we'll go to the next slide. Okay, so hopefully this kind of drives home the point a little bit why we're drawing a distinction between traditional single family rent and build for rent. But again, if we look at kind of how this all started, the single family rental was focused on acquisition and management of existing housing product through institutional and smaller scale investment vehicles. And again, even now, it's still early days as an asset class. And there's a ton of institutional foreign investment over the last decade that's happened. But again, what happened early was early investors benefited. They bought a ton of distressed properties at dramatic discounts. But now what they're really trying to do is figure out how to operate and manage those assets effectively and at scale, and to figure out what the projections have to be, for revenue and actually meeting those projections. So I think there's an issue. Obviously, a lot of that inventory, if not all, most of the inventory, if not all of it, has been sold that comprise those portfolios. But it's interesting what's happened now the last couple months with COVID. There's always a possibility that with lowered asset values and potential for increase in foreclosures, that cycle could start again, right? So I think what we saw was, over time, owners and investors both are comparing and contrasting the characteristics of single-family rental against multifamily. And again, we talked about before, there's changes in household structure that are shifting, the product demand. Even though a lot of residents initially may execute similar type of leases, single-year leases, single-family rental leases are, as a trend, are starting to trend longer, right? And I think all the builders now and all the long-term operators like Invitation Homes are really working to figure out how to extend those leases and make them stickier in terms of keeping tenants. But again, I think one big thing that that space has struggled with was really making sure that, as they're buying all these homes, they're not homogenous in terms of construction or, appliances or anything else. So the warranty and sort of the maintenance over time, the work order management has been quite difficult. So I think one more thing that we've really dealt with in this space is the lack of really a software solution to actually manage those large portfolios. Because again, our clients are working with existing, multifamily focused solutions to try to manage all these assets. But again, it's not ideal. We made it work at scale, but again, having something that's actually built for a single family rental property is something that doesn't exist yet. So the next thing is, fundamentally, single family rental, it's still an evolving space. And so I think one of the big things that we have done, in our capacity as consultants, we're really trying to help clients build operating models. How do they actually build, expense models and revenue models that make sense? How do they understand how to manage these platforms effectively and actually get over some of these things with processes and systems and bad data that don't actually work? So again, what we said before, it's still early days. And again, financial markets analysts are still trying to figure out how to embrace this as an asset class as it continues to grow. I think one of the biggest things we've seen is, significant public relations risk does exist. So a lot of bad press, it's happened the last 3 or 4 years in terms of, bad experiences customers may have had. And really trying to figure out how to manage their expectations and make sure that the public relations risk doesn't escalate to the point where it can't be controlled. Right? So I think the biggest thing here is, it's a great quote, all the capital that's pouring into the single family rental market, it's bumping up against a tough competitor, which is the consumer. Because now the consumer, with all its heightened competition, is really causing the home builders to actually, in many markets, to push their strategy into new development, right? So the expectation for the product is escalating significantly. So that brings us to the next part, which is really away from traditional single family rental, and this is into build for rent, right? So again, what we're all seeing is traditional home builders now are transitioning a part of their business into single family rental. So again, I think what we're seeing over time is there's improving technology platforms that are helping to reduce the barriers in terms of, once these homes are built, if the builders still have an interest in the operation of them, how do we actually move from the build component to the sale and warranty into management, right? So it's really, it's significant in terms of the difference. And again, what we're seeing, I think Betsy said this before, it can be perceived as at least a partial hedge against a downturn in the housing market. But again, it faces the same threat. People aren't paying their mortgages, they're also not paying rent, right? So it's kind of yet to be seen how much of a hedge that is, but at least, that's part of sort of the economic, theory in terms of branching out away from traditional home building. So again, what we said before, the multifamilization of single family. So changes in amenity planning and product design, it's really changing this from just a single standalone home to more of a community. I think a big thing that we're seeing, the planning strategies with exposing home builders to the SFR and build for rent product, and also the partnerships. It's interesting from an economic standpoint because it's all changing a lot. So either having purpose-built single-family rent communities with homogeneous builds, just like it would be for a normal community, or doing that, or allocating a tract to an existing community, or allocating specific lots that are for rent within an existing community. All those things are being considered, but I think another really big thing is including commercial and retail components into these new built for rent communities to make it more of a lifestyle experience, more akin to something they would see on the multifamily side. So again, that all kind of, points towards the same trend as the expectations of the buyer, the client, the renter, formerly the buyer, are escalating, and so the builders are having to deal with that.
Before you jump into the next slide and I switch over to it for you, we have some questions starting to come in through the chat function. You can also, go into Q&A if you're attending. We'll ask a quick question or two while we've got Dylan on. Then we're going to have Matt jump in, and then we'll open up for more questions at the end. But wanted to ask one to start, just to get your mind flowing on that front. Will the build to rent trend lead to more attention on energy efficiency and resiliency, the long-term cost and risk management of housing?
That's a great question. I think the answer is yes. I mean, I think at least from a product perspective, again, because the build for rent product and what we're seeing, and again, it is early days with some of our clients in terms of what their product design is going to look like. They are looking to ensure that, the same concepts that they're following for, their new home construction, they want to make sure that, taking some of the cues from multifamily, that they are as efficient as possible, not only in the building process, but in the, the long-term energy consumption standpoint. Because again, they want these homes to be durable. They want these to be reusable, and they also want them to be able to address the needs that are evolving with some of these, new customers and new consumers that have those expectations that, the house is energy efficient and does have those kinds of features.
So Matt, you've been doing this for a while. Is it the same on your end as well? Is this a key focus for you?
Yeah, well, I think what Dylan said is right. What the for sale builders are doing definitely drives a little bit of what we do on the energy side. At the end of the day, the tenants pay for the utilities, and the value proposition to the tenants of saying that we're going to save you X amount of dollars on your utility expense. We don't necessarily see that resulting in increased rent for us. So the value proposition, the return on equity invested to invest a ton into energy savings doesn't really translate to improved yield for our underlying fundamentals. With that said, we want to build a nicer house. And so we've been experimenting on several of our communities of different types of construction. We've done a type of construction where we don't use framing on the outside. We do more of a concrete solution. And that will result in definitely much better energy savings for our tenants. But there's pluses and minuses to everything. And so it's definitely evolving daily, monthly, and we are trying to stay on top of it.
Great. All right, well, we'll go back in. I'm still monitoring everyone's questions, so keep them coming, guys. I will make sure that we filter them in, but want to make sure that we also stay on time. So I'm going to throw it back to you, Dylan.
Sure. I just wanted to cover one quick thing from the previous slide.
Okay, sure.
Just the last one. So again, we talked a lot about kind of the strategy here, but the last one I think is the most important, the numerous challenges that we've seen. So, building the operating model, because again, this could be an entirely new line of business in terms of not just buy and sell, it's, buy and hold and operate. The partnerships and the kind of, both legal structures and sort of operating structures we're seeing to address the long-term management requirements, the capital requirements. It's all kind of evolving. I think from a builder perspective, it's interesting because our clients are having to look at adapting, feasibility studies, product selection, land due diligence, gross margin analyses, all those traditional things they've always done. Now they're having to look at all of that in the context of long-term rental cash flows, which is frankly something most builders have never done before, right? So I think that's really the biggest challenge they're trying to deal with and figuring out how that's going to work. And then the other thing we'll talk about on the next slide is figuring out how to utilize established rental metrics across this new product type, because for a lot of builders, it just didn't exist before. So again, we won't talk about this in detail. It's just kind of illustrative, but the NRHC did take a hard look at this and work with Green Street to say, in the long term, if you're using rental metrics that existed for retail and for office and for industrial, for decades, what might that look like in single family rental? And again, from a portfolio, leasing, income, asset value, and all these additional considerations, all these things to some degree have to be looked at in terms of, looking at how the economics of a new built for rent portfolio would actually, what would it look like, right? So again, some of these things, like especially stabilized versus unstabilized, I mean, this is something that would apply differently in terms of a brand new community versus, something that was kind of pieced together, using existing product. But for us, it's just very interesting because we're very familiar with how this works in a different environment, and now it's having to be applied to single family rental.
Gotcha.
So I think that's it for that one.
Okay, and there's a lot of detail if you're seeing this on here thinking, wow, I'm not going to absorb all of that. We're going to have most of these slides. A few things will be removed to protect privacy purposes, but most of the slides will be available for you to download afterward as well, so you can read through the detail and reabsorb it.
Sure.
So go ahead.
So I think we covered a lot of these already, but this is, as far as what we're seeing, we don't think this is just kind of a short-term event in home building, in real estate in general. We think these products will be permanent new fixtures in the housing market, despite, what's happened over the last couple of months. I think what we're seeing, working with, large-scale institutional investors as well, that, as the availability of product for those large-scale SFR operations continues to dwindle, then the home builders will continue to drive new development. There'll be new relationships that get built, between merchant builders and operating partners. There's just a lot of creativity that's happening right now, both on the building side and the operating side and the capital side. That's really interesting to us. And again, even, seeing BB Living and Toll Brothers and what Lennar is doing as well, there's a lot of exploration that's happening in terms of how those partnerships can be built and what's the best way for each builder to actually move forward. And then just a couple of things that, I think what we're seeing is this is not just economic in nature. There's shifting priorities in terms of perception and the value of ownership, the desire of consumers to use their money in different ways, the perception of the value of owning a home. And the organization of households, boomerang kids and older parents, multi-generational households that do change, and the structure of what the desire for a specific kind of housing is. And I think a question that did come up was offsite and modular, and we 100% think that offsite and modular is going to help drive some of this, just in terms of speed to market, speed to delivery, to be able to build quickly and build for purpose, in terms of having more product available more quickly. So that's something we've talked about in the past quite a bit, not so much today, but we definitely think that's a part of the story.
Okay, great. If you have more questions for Dylan, we will have a Q&A part at the end of the session, but I want to make sure we get into Matt as quickly as possible so that we can allow everyone to see all of his information that he's prepared to share with us. And then just keep the questions coming. We'll jump back into questions toward the end of the session after Matt presents. And then if we miss anything, you can post a question in the chat rooms on the site, and then we will also we'll also reach out to both Dylan and Matt and try and get answers if we don't get them online during the event. So Matt, take it away.
Hey, Betsy, thank you very much. I look back on the Chicago conference, and I forget what year it was, but it was a while ago, and I think back very fondly in those times, and I look forward to traveling and seeing new cities and experiencing them soon. So I look forward to doing that. So thank you for having me. I'm going to probably keep it a little bit more brief on a lot of the drivers, the high level demographic information that is supporting the thesis. I think Dylan covered that really well. I don't want to be repetitive. I want to give a chance for people to ask questions. I've seen a couple questions come through the chat rooms. So I'll try to kind of blow through some of these slides pretty quickly in terms of why we like the industry, and then kind of leave it up to you, Betsy, to
Okay.
ask questions. I can't really read questions and answer them and talk at the same time. I can only do a couple of things at once. So I'll defer to you in terms of.
Sounds good.
So in terms of BB Living and who we are and what we do, we build new houses for rent, and we build a community. I think Dylan kind of touched on the scattered houses and then more of the purpose-built single-family rental. We're solely focused on the purpose-built single-family rental. We started buying scattered houses in 2011 in Phoenix at the foreclosure auction, and then when Blackstone Colony and a lot of those people came into the market in the spring of 2012, we were immediately put out of business. And so we had to figure out a new strategy, or else it was going to be a very bad start to a new career. And so what we figured out is that we could actually buy land and build a whole community of single family houses and offer a lot of the services that people come to expect from rental properties, the on-site amenities, the on-site leasing agents, the on-site superintendents, the quick service, and yet still provide single family living with all 3 and 4 bedroom houses. So we focused on that strategy in 2012 and started buying a lot of land in Phoenix to develop these properties. To date, we've developed over 1,000 properties in Phoenix. Recently, we partnered with Toll Brothers and a large financial partner to expand the business nationwide. So now we're looking at several markets across the country, focused on the Mountain West, Southwest, and Southeast. We look to expand that business pretty aggressively over the next 2 to 3 years. With respect to COVID and the impact on the business, it's hard. We're in the whitewash of it all right now, so it's hard to really have a great perspective on the business. But I think that long term, this is actually very positive for build to rent and single family rental. And I can kind of go into those details and why I think that a little bit later. But maybe to backtrack and just go through kind of where we were on a pre-corona basis and where I think we'll be on a post-corona basis. Maybe that's the best way to do it. So this slide 13, really encompasses everything that we find attractive about the industry. There's been a huge amount of households formed over the last 12 months, and half of them were renters. And I think when you look at the population of renters, for our renters, our average tenant is 30 years old with 2 kids. So that's a young family who is accustomed to renting. They want to rent, but they need more space. When you think about the multifamily supply out there in the market, 90 to 92% are all 1 and 2 bedrooms. There's really effectively very little 3 and 4 bedroom supply. So as people grow, mature, form households, there's really not a lot of supply for people to rent. I think historically, a lot of those residents either entered the for sale market and the new home market, or they chose instead to rent a single family rental, which was managed by mom and pop investors. And so really with the product that we're offering is a more institutional product that has all the amenities and has space. And we think that demand, the 1.2 million households that were formed in the last 12 months, 50 of them are renters, that's kind of squarely coming to where we are in the market. And so we don't see any of those demographics pointing to a negative picture for the product that we build. As I mentioned, the average age is 30 years old with 2 kids. And these are people who don't have a lot of savings. They don't have I think 80% of America has less than $10,000 of savings. That's staggering. And so how are you, and especially now on a post-COVID basis, where are people coming up with a down payment to come in and buy a house. I personally have a feeling that the entry-level for sale market really should not be as big as it is. I think it should lose market share over time to more rentals. I think people should rent a product similar to ours for a period of time until they strive, until they build up the down payment and the savings to do the move up purchase. That's just I'm 100% biased in that opinion, but if you think about it, I think most people, when they buy an entry-level house, they hope that one day they are going to move up into the move-up segment, or maybe one day the luxury segment. And the amount of down payment that people have to put down and the savings into a house, where people don't necessarily view a house as an equity creator anymore, then they're better off renting a house, saving that money, adding to their down payment, to their savings, and then purchasing the next house. 2/3 of our move-outs are people who are buying houses. So clearly our competition are not other rental product. It's not a multifamily product. It's not scattered single family rental. People who leave are not choosing to rent another space. They're leaving to buy a house. And when they're buying a house, they're effectively skipping the entry-level product entirely and going to the move-up segment. So the average house purchase of our tenants when they leave is $375,000, which in Phoenix is squarely in the move-up segment. And so these are people who have good jobs. They make a very good living. The average household income in our portfolio is over $100,000. But they just are choosing to rent where they don't have the down payment to rent. And then when they decide to enter the for sale market by choice, where they're able to, because they now have the financial wherewithal to do it, they're then buying a house. So when they buy a house, they're buying within a very tight radius of where they rented from us, usually within the same community. So they are. What I think is happening is that our renters are, okay, I have a kid. I want to get my kid into the right school district. Where's the best school district? Okay, BB Living has a product in this school district. Awesome. I'm gonna get here, get situated, start to fall in love with the community. When I fall in love with the community and I feel a little bit more stable, I am then going to purchase a house. And so that's what's happening in real time in our portfolio, and I think that should continue. So if you just skip this page and go to maybe page 4, the next slide. So this slide gets to what I said earlier, which is that the average demographic of our tenants is 30 years old with 2 kids, and that is the segment that's growing in terms of net households being formed. And so the market is coming to us, and it's a very, very big market. This millennial market the millennials are going to want more space. They're going to want more area to move around in their own personal house. They're not going to want to live in a multifamily apartment for the rest of their lives. And so we believe that we're providing the space for them. So if you go to the next slide, slide 5, this is just showing that our demographic is growing in size and having an increasing propensity to rent and single family rentals. So in 2007, only 13% of people in our respective age group chose to rent. Now that's up to 19%. That's huge. That's a very, very big difference. That's a 50% increase in rental demand amongst that age group. And so and I don't think any of this is changing in a post-COVID world. I think this is only going to increase dramatically in a post-COVID world, which is having a real impact in real time. And I think it's going to have a very lasting impact. This is not a short-term blip. I mean, we're all stuck in our houses. The last thing that this COVID event is causing for us is not making us more confident to go out and buy houses. That's for sure. I mean, I think if you think about it, consumer confidence is going to go way down. There's nothing in here saying, oh, wow, now I'm excited to go and buy a house and put everything I have saved for the rest of my entire life into a home purchase. I think in order to see a real big increase in new home sales, you're going to need to see a lot of consumer confidence. And I think that you're going to see the exact opposite happen. So for sale housing is going to be exceptionally challenged over the next year, 2 years. And what's going to drive more people into rentership. And for us in our business, that's going to have a couple of positive things and potentially a lot of negatives, depending on how long this lasts. But in terms of the positives, I believe that our build costs are going to come down significantly, which should be very beneficial for our yields. Our rents may fall as well, but we don't need to maintain. We don't build our business because we need X amount of rent. We build our business because we need a yield on cost is how we look at our business. What is the return on investment? And if our build costs fall, our rents are able to fall, and we're still able to provide the value to the consumer. And so Stephen Kim from ISI believes that building starts are going to fall 60% in the second quarter, and that's his base case. And frankly, I think his base case is optimistic. I think it's going to be worse than that. And so what you're going to see is build costs come down significantly. And we are in the process of finding what that market is in real time. So flipping to page 7 or maybe actually page 8 would be a better one to go to. I just kind of covered that. I don't think that there's going to be a lot of new supply of housing in the next year. But then also page 8, the houses that are currently on the market, the scattered single family rentals, are on 64% of them are over 40 years old. So the product that's out there, the large houses for these families that that want space to rent, aren't what they want to rent. They want brand new. They want the amenities. So we offer the swimming pools, the splash pads, the fitness centers, the dog parks, all in the same community. Generally, we build within master plan communities. So they all have access to a bunch of other communities within the same area. The product is brand new. It has all the specs that consumers have come to expect when they buy a new house. If you were to the way we build our house and the way we base our specs, or is what an upgraded purchase would be. So every home builder, whether it's Lennar, has their base package, and then they have, on average, tenants, residents, homeowners pay about $10,000 to $15,000 to $30,000 more in upgrades. We offer that upgraded package into our units. And so when residents come into our product, they see everything they come to expect from a brand new house. And then I think, it's kind of skipping ahead all the way to build to rent as an asset class. So I think you can go to slide maybe 13 would be the next thing. So build to rent has changed dramatically. I don't know, Betsy, how am I doing on time? Can you hear me? Dylan, can you hear me? Okay. So build to rent has changed a ton over time from when we started to where we are today. And it's a very big category. And so I think you need to create subcategories of build to rent. What we do is large, the average square footage of 1,800 to 2,000 square feet, 3 and 4 bedrooms. And then you have a whole nother segment, which is where Christopher Todd operates, to the extent people know that name, or Next Metro, which started when we did in Phoenix. They build on average 900 to 1,000 square foot units. So they're really a deconstructed multifamily complex where yes, they're detached and they're single family, but they're very small, predominantly 1 and 2 bedrooms. So that's on a different spectrum of build to rent. So I think going forward, build to rent, which is a very big category, should have subcategories. And we should be on one side of the spectrum. And I think that those guys should be on another side of the spectrum. And there's been a huge amount of new developers coming into the space, but I would think I think the vast majority of them are going to more of the Next Metro and Christopher Todd model away from ours, which makes me think maybe we're doing something wrong. But I don't know. I guess time will tell a little bit on that one. But if you go to the slide, it says page 13. I'll go to the next slide, Betsy. Yeah, that one. So this kind of shows where we started and kind of where the industry has progressed forward in terms of build to rent. So we have us in 2012 with Next Metro, and now if you go all the way to 2019, you see a much larger list of people. And then you see companies like Lennar and a lot of other home builders. So you have kind of 3 strategies, as I say. So you have ours, which is a community, In the middle, you have a Lennars, which they sell sometimes the first 10, the last 10, and a lot of other home builders where they're selling brand new homes for rentals, but they're not doing a full community solution. It's more of just a group of houses within a community. And then you have the Christopher Todd and Next Metros on the far side, which is a community of smaller single family rentals. So I think that the industry has really grown over time, which is awesome. There's been really good trades. Christopher Todd has done exceptionally well in terms of their strategy of selling assets at a very low cap rate. So they've proved it. They've round trip deals. And I think as a result, as Dylan alluded to, you're seeing more and more equity come into the space, which should help the industry grow. And that's really, Betsy, I think, we can kind of go into some of the details of how ours are different from the more of the horizontal apartment complexes, the Christopher Todd and Next Metros, but I'll leave it up to you to kind of steer the conversation.
Okay, I want to make sure we've got a ton of great questions in here. We're not going to be able to get to all of them. There's probably a good 15 or 20. So I want to make sure we get through a few of them. It's currently about 11:40. We're set to be done at 11:45. I'm going to stretch it to a couple of minutes before 10 till 12. Just so the team who's on the line knows that I'll be in the next session prep a little bit late, but want to make sure that we get to some of these questions. So I'm going to go back up to something that we heard a while ago. I think we kind of answered Kelly Lawrence's question about what amenities look like for these communities compared to Class A apartment communities, in what Matt was saying about being in the master plan communities. Do you have anything to add on that front, Matt?
No, I think that it's a pool, resort style pool, it's a fitness center, it's a dog park, it's everything that someone, if they're all the bells and whistles of a Class A apartment complex, we try to provide to our residents. Perfect.
So how are single family rentals being received by communities and municipalities? Is there NIMBYism or any legal hurdles or regulations that are different from other builds that you're seeing?
Yeah, that's a great question. And absolutely the answer is yes. We get it every single deal. We have to deal with it, either from current residents or municipalities. And we've been very effective in navigating that, but it's always a cause of stress and consternation for us, Facebook pages, etc. Now we have so much data because we deal with this all the time. We have so much data to show that it's always the same arguments: decrease in asset prices, bring in a riffraff, crime rates are going to go up. That's all the things. We have so much data to show the exact opposite of that. And so it's a matter of getting in front of people, doing town hall meetings, explaining who we are, what the average resident looks like for our portfolio in terms of the average household income, the jobs, and how our renters are no different from everyone else who lives in that community, except that they have higher standards to rent from us than they do to buy a house. We do criminal background checks on all of our residents. No one with any type of bad crime will ever be allowed to rent in one of our units, whereas they can buy a house and they could be your next door neighbor, but we're really protecting against that. In terms of upkeep, it's much, we're all part of the HOA. We're all part of all the grass has to be mowed. There can't be any trash on the front. And if there's a fine, we get fined. It's not the resident. And it's not like an absentee landlord of someone, a doctor in Minnesota who owns a rental property in Phoenix, and you can't really track down where that guy lives. We're there. We have a leasing office. We have a superintendent. This is going to be pristine. And so it's just a lot of communication. And frankly, we made a lot of headways compared to where we were in 2012 on that point. And so I'm very encouraged by it. But yes, it's it's something that we spend a lot of time on.
What's the current supply versus demand balance in single family rentals? If undersupplied, are modern methods of construction like modular or offsite being implemented or considered as solutions?
Yeah, I think modular is a great solution. It's tough. It's something that we also spend a lot of time on, is trying to figure out the best way to build these houses. And so we spend so we're in frame construction in Phoenix. We build about 18 starts a month, and we can roll that out exceptionally efficiently. People talk about even flow production model. George Casey really is the one who's helped me grow this business from nothing, because he's such a thoughtful guy and such a leader in the space. So he's the one who kind of helped gear us to where we are today. But even flow production, 18 starts every month, enables us to build exceptionally efficiently on a frame basis in Phoenix, and generally matches what our absorption pace is. So by the time we finish construction, we're about 80 to 90% leased. And that's a great situation and a great advantage over traditional multifamily. Now, can we be improved by going modular and drive down our costs and potentially have 20 to 30 units available per month lease instead of 18? I think so. And so we're just going through a lot of those discussions to date as we speak. We've tried different strategies. We've moved away from different strategies and have come back to frame, but it's evolving very quickly.
Okay, I'm going to ask you guys one, maybe two, depending on your answers, more questions. And if you've posted a question and it hasn't been answered yet, as I mentioned earlier, we'll make sure that we get an answer to that for you. You can also, I'm just going to show you guys this, you can also go into the lounge and click on the button to meet the speakers and reach out directly to Dylan or to Matt there. And in the, if you go to the lobby and you go on the bottom left, there's an area that says chat rooms, and there's a chat room for this particular session. So you can also post comments there, but we'll keep everything that you've submitted to us and make sure that we coordinate getting questions answered as well and getting that info back to you. So in the meantime, this is probably our last question. Home ownership has traditionally been a leading platform to build wealth for families. The rental model potentially limits the wealth creation. Have you considered a rent-to-own structure, or any of your clients doing that in hybrid communities?
Then I can address the first part of that. I think it's sort of a broader conversation about the perception of the not necessarily the economic value, but just sort of the intrinsic value of owning. And it's really these younger generations that, you know, as Matt said, they're used to renting. They have a high standard of what they want, and they're able to get a lot more for their money. So they sort of see the day-to-day in terms of what they're able to actually get and what their lifestyle is like being much higher if they're just continuing to rent and maybe not considering the long-term, you know, equity that they may not be building in a home. So it's really just sort of, I'm not sure if this is going to last forever, but just psychologically with the younger generations, we are seeing their focus and really their priorities changing in terms of where they're choosing to try to build wealth over time, you know, away from the traditional, you know, put it into a home, you know, and let it appreciate and actually take the equity out of that. And again, is that going to last forever? We don't know. But again, it's sort of driving some of these factors, at least with the younger sets.
Okay. Any comments, Matt, before we close out?
No, I think Dylan answered that exactly right.
Okay, perfect. Well, again,
an answer specifically, no, we don't do any rent to own in our portfolio.
Okay. Yeah. All right, perfect. Well, thank you guys. We do know I believe Dalton Communities in Florida does some rent to own with their customers. They have people who end up buying their, sometimes buying their rental properties. They also sell some of their rentals after time as well. So perhaps we can reach out to them and get some feedback as well on that front. But thank you guys again. Thank everyone for participating in this session. The next session is going to start at noon. We'll see you there. And in the meantime, head over to the lounge, take a break, and come back soon. And thanks again, guys. Thanks, Dylan and Matt.
Thank you very much. Appreciate it.
Okay. Bye-bye.